Another day, another dollar, another all-time high in the S&P 500. Equities continue to move higher and continue the trend we've seen over the last 2 years. And stocks right now just seem unstoppable, with even short sellers in HIMS, SMCI, Oklo, and BBAI collectively losing $73 billion since the start of this year. The market's roaring ascent feels like a freight train with no brakes, but will we ever get another material pullback? That's what we're going to talk about today, because under the hood, there are some very concerning things that we need to extrapolate and dissect. One such thing is home builders. These stocks are not acting well. Toll Brothers just posted a double miss in earnings and revenue, and this is simply an early sign of something more sinister starting to rear its head through the mist. So with inflated valuations, over-leveraged portfolios, and stocks at all-time highs, is this bubble about to burst? And when it does, how low do we go from here? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks climb to another record high as stocks remain resilient despite threats of more tariffs and a continuously cautious Fed. We saw varied price action throughout the day, but mostly green. We had some of the mega caps here. Microsoft up 1.25%, Google up 0.82%, Meta down for a second day in a row, breaking its 20-day win streak yesterday. Netflix was green, and we saw software was a mixed bag. CRM, Palantir, ServiceNow were red. Oracle, IBM, Accenture, Google, Microsoft were green. Such goes the market. Apple and Nvidia were kind of flat today, but the rest of the hardware actually kind of green, as well as semis. AVGO was flat. The star today was probably healthcare. They were very, very green, along with stuff like staples, and it was just green all over today. It was a very resilient market, held back by some very niche names that had very specific market impact news. And like yesterday, we actually saw inflows into the New York Stock Exchange, outflows here in the Nasdaq. So, under the hood, we're still seeing that broad market rotation. And if you actually look at what were the losers today, XLK, XLY, these mega cap names saw outflows for the most part. And then again, we rotated into the broader market. However, a couple of the concerning things, if we actually look at what was the best performing sectors here today, XLV Healthcare, XLP Staples, XLU Utilities, these are all defensive sectors. So we saw growth and quality for defensive assets. That can be a little bit concerning. If we see a continued rotation over the next couple of days into these names, then we can say, hey, what's going on under the hood? What does Wall Street, what does smart money see? But in the here and now, I wouldn't just peg 1 day's worth of trade on it. However, it is notable that these defensive sectors did outperform, relatively speaking. The SPY was up 0.23% today, and also in the green was real estate, comm services, industrials, and then gold was largely flat here today. We saw outperformance in sort of the value components of the market, as well as the blend in large cap and mid cap, but you saw the market sold small caps across the board, as well as large cap growth and mid cap growth. The market sort of, again, just rotating into the broader market. And part of the reason why was because of the Fed. We got the FOMC minutes today from the January meeting, which was the 28th to the 29th of last month. And it gave us a peek into the Fed's thinking. They noted that the economy and labor markets are holding strong, but inflation is still a bit high, with risks tilting upward now. The Fed is in no rush to cut rates. They want clearer signs that inflation is headed towards 2%. They even discussed pausing balance sheet cuts due to potential US debt ceiling drama. Bottom line, guys, restrictive policy might stick around if the economy keeps humming along. And that's why we saw the price action we did today. Value is always going to outperform growth, especially when the cost of capital is expected to remain high. It just makes growth stocks slightly less attractive. And that is why we actually saw the rotation we did today, and probably will continue to see this broad rotation happening under the hood. Another reason why we saw an impact to growth stocks as well as small cap stocks actually had to do with the trade front. Trump's fast moving policy overhaul has been on the top of mind of investors waiting to assess the impact of tariffs. Now, last week, Donald Trump announced 25% global tariffs on steel and aluminum imports, as well as reciprocal tariffs on pretty much all of its trading partners. Now, more recently, yesterday, Trump is said to expect additional duties on autos, chips, and pharmaceuticals, and a flat tariff in the neighborhood of 25% would apply to all foreign automakers. That would start as soon as April 2nd. Tariffs of 25% of Mexico and Canada are set to also come in next month, while 10% duties on China have already been implemented. So, the FOMC minutes, Donald Trump's newest tariff policy really shaking up markets, but stocks resilient as a whole. We also got some market-moving economic data today, building permits and housing starts. Now, building permits actually beat consensus expectations. However, housing starts missed. Now, this is largely positive because building permits is actually sort of like an indicator for what's coming up in the pipeline. Housing starts is sort of houses that already have had their building permits approved, and now they're getting started. So building permits is obviously the more important figure. Nonetheless, we did have mixed data, and I would say slightly aired to the positive side. Now, looking at market movers in terms of stocks, guys, heavily shorted stocks have soared in 2025. Short sellers have collectively lost about $73 billion on the back of just these names right here. Stuff like HIMS, Oklo, SMCI, and BBAI have all soared almost 100%, and in the case of HIMS, 200%. Absolutely crazy move. So had you bet against these guys coming into 2024, you're probably deep in the red and probably waiting for a margin call very, very soon. Another market mover today was Nikola Corporation. Guys, they officially filed for Chapter 11 bankruptcy. They were down 40% today. At one point, they were down 60% right here. Absolutely crazy price action, and probably expect this to go lower as more details and news unfold and how the restructuring is going to take place. Now, Toll Brothers, America's luxury home builder, fell 6% today on its Q1 earnings, missed revenue, missed earnings. However, guidance was so-so, and that's why the stock wasn't down like 10% today, because Toll Brothers remained optimistic about the long-term housing market, citing favorable demographics, and the company believes the luxury niche is well positioned for continued success. Nonetheless, a lot of these home builders are now down like 30%, and I was looking at some of them and their overall valuations. They all trade at like a 9 or 10 PE. They're looking very, very attractive, pay pretty good yields. Most of them are buying back quite a bit of their stock. I mean, Toll Brothers was buying back, I believe, 5% of their stock in the last 12 months. So there's definitely some good value if you have a really long time horizon. I'm talking 5-10 years. I think this is probably a great place to start accumulating some of these home builders. And then another earnings mover here today was actually Carvana. It was down 7%. Now, I don't know what the street was expecting with this name. Now, they posted 0.5% in earnings per share. The expected number was for 0.23%. So they almost doubled. Actually, no, they did double earnings per share expectation. They actually beat revenue as well. And the company's management team also said, looking forward, Carvana expects significant growth in both retail units sold and adjusted EBITDA for full year 2025, including a sequential increase in both retail units sold and adjusted EBITDA in Q1 2025, assuming the environment remains stable. So pretty much you had a double beat, management indicating towards a raise, sequential growth as a raise, but the street not really feeling the vibes. I'm not really sure why the stock isn't up like 10%. Maybe it has to do with some of the accounting irregularities that Hindenburg Research brought to light. Nonetheless, I thought these earnings were pretty good, but however, I did just skim over them. Then looking at market breadth, guys, we saw 2,600 advances, 3,600 decliners. However, the markets were still pretty resilient. So a lot of the decliners were sort of these smaller stocks. So I guess you would call this negative breadth with regards to how the S&P 500 performed. And then looking at market momentum, we're still very much in the green. Shorter term, medium term, and longer term averages all look very, very well positioned for us to buy any dips and continue to move higher. This is the type of momentum you like to see at all-time highs and in a bull market. So as an investor, all you have to do is be patient and ride the wave higher. Now, looking at stocks as a whole, the S&P 500, that is another new all-time high at 6144, up 0.24% today. The Nasdaq 100 largely flat, the IWM down 0.34%. If we actually just extend this right here, we see down another 0.18% in extended hours. Seeing a bit of red here in the after hours, but take it with a grain of salt. It tends to be lower volume. Mid caps fell, profitable small caps fell. The RSP was up 0.2%. A mixed day, but overall, with the S&P 500 and Nasdaq 100 gaining, generally you're going to see positive portfolio skew to the upside. Yields were kind of mixed. The 30-year yield was flat, but the 10-year and 2-year yield fell. The dollar gained 0.15%, and again, that had to do with some of the underlying tariff fears. And then bonds was up 0.14 and 0.12%. Bitcoin was up nearly just shy of 1%, still at the 96,000 level. Then we saw metals slightly down on the back of yesterday's strength. For everything we've seen today, guys, I mean, stocks were very, very resilient in the light of FOMC. However, a couple of concerning things. We actually didn't see the gamma flip move up again, and we did actually get a close above here. So, guys, I am expecting some downside, maybe some consolidation here, and then some downside into the end of the week. I do think we're probably going to move lower, test some of these lower levels, unless we actually get the core resistance to move up, which we haven't seen today, which is very, very interesting. 6,000 or 59.95 is still where the gamma flip is. So, guys, if we do get a pullback here, which if we do get a pullback, it's going to feel like the market's falling apart, because from where we are right now to the 59 level, that's a 2.4% pullback. But, if we actually do see like a 2% pullback in the S&P 500, that is simply still an opportunity for us to buy the dip. The problem is if you have a 2% pullback in one day, people tend to freak out, get a little scared. But had you bought the dips right here, and here, you'd be sitting very, very pretty on overall gains at new all-time highs. However, guys, do understand that based on the structure that I use, the gamma flip zones, right? The core resistance, put support. Technically speaking, we should see a little bit of downward momentum into the end of the week. The same is true for the Nasdaq 100. We closed at the top end of the range. Do expect a little bit of downside. I'm not saying we're going to go down like 1% or 2%. We could still definitely trade at the top end of this range. I'm just saying from a risk to reward standpoint, risk is slightly to the downside, but I'm definitely not taking shorts, not at new all-time highs. I mean, equities look very, very constructive, and I do think we're just going to keep chugging along higher. We just made the third new all-time high for the S&P 500 for 2025. The RSP looks very, very constructive. We're right here at the top end. All we need to do now is break above, and then we can move higher, onward and upward for the RSP or the equal weighted. Small caps looking so-and-so. The problem with small caps is that most of them still haven't actually made a new all-time high, particularly the RTY, which is right now smack bang in the middle. In positive gamma, it's in the middle between the gamma flip and the core resistance, which means there is a little bit more upside left. Small caps acting very, very well here at the gamma flip. So yes, we have broken it. Don't get me wrong, but we've paired those losses very, very quickly, come back into positive gamma, and that is often the sign of a bottom put in. I am very, very bullish on small caps to go higher for 2025. However, that must coincide with rate cuts, although I do think we're going to get significantly more rate cuts than is priced into the market. I think we're going to see some form of a growth scare that's going to coincide with deflation risk, particularly from shelter inflation. That is my overarching thesis for 2025 pertaining to rate cuts more specifically, but the overall market looks poised to go higher. I mean, guys, on the back of everything we've seen, tariffs, Fed policy, earnings, DeepSeek, everything in between, a new presidency, stocks are just so resilient right now. And really, you just want to ride the wave. All you really want to do is buy any dips that we do get, like this, and simply just hold. That's all you really want to do in a market like this, in the S&P 500, the Nasdaq, and everything in between. Now, let's actually look at the 10-year yield where we stand now, guys. We have said that right here on the 10-year yield, this 4.5% level is critical. If we remain above it, we can actually go higher, but if we go below it, we can actually move significantly lower. Ultimately, what we want to see is the 10-year yield move lower. Now, that's also going to depend on what the dollar does. We are seeing some very, very key consolidation here at the 107 area. The dollar was up ever so slightly today. And again, like the 10-year yield, we are at a very, very critical level. We stay above this and use it as support, we will move higher. However, if we break below, use it as the resistance, we can actually see the dollar move lower. And I think yield and the dollar are going to follow each other. If yields break lower, the dollar will follow. If the dollar breaks higher, yields will follow and bonds will act as a result. Nonetheless, we actually do want to see yields and the dollar move lower. However, with Trump's posturing and tariff policy, that is going to keep yields and the dollar relatively elevated. But you can see the market trying to figure out what to do next. We're at this critical zone with the 10-year yield. Everything is going to come down to what Donald Trump does on the tariff front and the macro front and then the Fed's policy. Those two things together is going to determine where we go next with yields. And this is going to really affect the overall equity markets. What we really want to see is lower yields and a lower dollar. That's going to be really, really good for risk assets moving forward. But guys, you know the game plan for the rest of the week. The S&P 500, we're at the top end of the range. Our target is the gamma flip, looking for lower levels in the S&P 500, right? Similar with the Nasdaq 100, we're looking for a little bit of downside, potentially an opportunity to buy the dip. For the RTY, we're looking for us to continue the move higher that we've seen from these lows right here to the 23-25 area. Still, I'm not taking shorts. Any dips we do get, buy those dips, because I think we are going to go higher, especially if the fundamental picture stays as it is or even improves for the rest of the year. Diving into sentiment, this is the weekly poll we do on this channel. Every single Saturday, I pose a question. And this week, I asked a broad question. How are you feeling about stocks? Are you bullish, bearish, or neutral? 51% of you guys were in the bullish camp. Very, very bullish sentiment. However, we did see elevated bearish sentiment, relatively speaking, and only 18% of you are so-and-so. So 49% of you are neither bullish, but 18% of you not exactly bearish. And I guess this is the type of sentiment readings you will see at all-time highs. However, if we do get volatility in the next 2 weeks, it's to be expected. Median returns around this time of year, the second half of February, tend to be flat. Average returns, we tend to see negative 0.5%. So we could see pretty much flat to slightly negative returns over the next 2 weeks here to end February. That's completely normal, but we do have to look at the big picture. Market breadth has been fantastic. More stocks are outperforming the S&P 500 than what we've seen in the last couple of years and what we saw in 2024 as well as 2023. And we are very close to the median average going back to the 1990s. So market breadth looking very, very solid, and it is simply a stock picker's market right now. You could really just pick out the top quality stocks in each sector, look at the ones that are growing earnings, and if you put your money in those, especially if the valuation looks reasonable, you're actually going to do pretty well this year. However, you do have to pick your poison when we see market breadth broaden out, because a lot of the momentum we're seeing that's holding the S&P 500 back is stuff like technology, communication services, and discretionary, the bigger names, the bigger boys. However, you do have to look at the overall fundamental picture, and things are looking very good. The proportion of S&P 500 companies beating S&P 500 estimates right now is sitting at 77%. The average going back to 2006 is 74%. So where we are right now, looking very solid. Earnings are great. The fundamental picture is great. And corporates are using that money to buy back stock. We're looking at about $1 trillion worth of buybacks, that's US dollars, in the S&P 500 over the next 12 months. The announced 3-month sum of total buybacks close to $300 billion. The actual gross buybacks quarterly is sitting at around $250 billion, guys. And if this path continues, simply corporates buying back their own stock is going to put a huge bid under stocks. And it also goes to show the overall sentiment and mentality that corporates and executives have towards their stock. They simply think it's cheap or reasonably priced or worth buying back in the context of the macro environment looking very favorable. Now, we did see the Fed's GDP move down in a very big way, down to about the average, what we've seen here with the blue chip consensus, to about the 2.3% mark, down from the near 4% high, however, still well above the long-term average of 1.5%, and anything between 2 and 3% is largely robust. We have seen economic data pull back in recent months. This is the US Economic Surprise Index, and while we have seen major upward surprises since about mid last year, we have seen the data in the last couple of months come in a little bit weaker than expected, but we are still well above the zero line, which is this level right here. So overall US economic data is neither coming in bad nor good. It's coming in just right, and that is going to support equities. Now, something that's very, very interesting is the Doge boys. Now, if you have a look at the change of the fiscal deficit since October 2024, this was the inauguration right here, and we've actually seen the deficit decrease. You can see that these are negative numbers, so the lower this is, the bigger the US deficit. We've seen that move up in a significant way. Now, this isn't due to just the Doge boys. However, by and large, it mostly has to do with them. And if you actually look at the Doge debt clock, I think they've saved in excess of $100 billion. Now, I'm not exactly sure what is the makeup of this, but that's very, very good for the taxpayer nonetheless. Now, something very interesting right here, guys, something I thought I'd show you. Did you know that the best S&P 500 real index returns, guys, this is real returns, right? In other words, returns in excess of inflation is actually during stagflationary periods where we saw mid-teens growth in the S&P 500. Second place was actually in deflationary recession periods, right? And the worst performing was deflationary growth. And then in third place here, inflationary growth. So very, very interesting to see this in particular. I did not expect this at all. So if we do go into periods of stagflation or deflation, guys, you still really want to stay invested, hold equities, hold assets, because they're a great hedge against inflation. Now let's talk about earnings tomorrow. The two big names reporting before the open, Alibaba and Walmart. That's about it. Shake Shack, I guess, but not really a market mover. These two, though, are really going to move the staple sector as well as Chinese stocks. And after the close, we have Melly, Rivian, Block, Newmont, Bookings Holdings, Texas, Roadhouse, and Dropbox reporting. And then looking at data for the rest of the week. Tomorrow, the only big data point we have is initial jobless claims. We do have Philly Fed manufacturing as well. And then we have a couple of Fed speakers, Mazalim, as well as Goolsby reporting. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.